please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good evening, you're watching CNBC TV18 and this is After the Bell. Let's take a look at the top stories that we are tracking at this hour. The bears and the bulls scurrying for cover. Nifty ends at a one-month closing low. Sensex dips over 250 points. Nifty mid-cap index posts the biggest one-day fall in 9 months. The North Korea-US tensions continue to plague global trade. All major Asian indices end in the red. European markets also open on a weak note as the British FTSE cracks more than 1%. Relief for Kumar, Infra and Prakash Industries. SAT lifts SEBI trading ban on the two companies. Questions SEBI on why the two were listed under shell companies when both have a turnover of 3,000 crore rupees and pay taxes regularly. The government's midterm review reiterates LPG cylinder subsidy to be eliminated by March 2018. Overall subsidy bill to fall to 1.3% by 2020. Adds that says GST rollout unlikely to cause tax shocks on collections. The government aims at increasing expenditure for social schemes. Special impetus to be given to the agriculture sector. Pet projects such as Swachh Bharat, Pradhan Mantri Awas Yojana and Sarva Shiksha Abhiyan will also get a boost. CNBC TV18 news break confirms Softbank invests $2.5 billion in Flipkart, becomes the second highest shareholder in the e-commerce giant. Flipkart says that this would boost their balance sheet to over $4 billion. Bharti's plans of selling its tower business to KKR and Canada Pension Plan Investment hit a roadblock. Indus Tower buyout crucial to Bharti Infra deal. That's an exclusive. Well, the top story on After the Bell. The Bears have it. The Bears have it. The Bears have it. It was a bloodbath on Dalal Street today. That, in a sense, concises exactly what happened. Nifty cracked the 9,800 level intraday trade but recovered marginally in the wee hours of trade. That index ended at a one-month low at 9,820. Now, the Sensex also cracked 0.8%. That slump was more severe in the broader markets. The mid-caps cracked over 3%. The Bank Nifty ended almost 0.7% lower. The only silver lining was the IT index, which closed with gains of about 0.5%. Let's bring in Anuj Singhal, as always, to take us to the highlights of the day. Anuj, consolidation pretty much creeping in. Is this the last leg of unwinding, though?
Well, brutal fall for the market, especially for the mid-caps. Not entirely unexpected because we've been talking about this deleveraging process and the fact that global markets also have been looking quite weak. In fact, the mid-cap index has now corrected 5% this week, and the Nifty itself has now completed biggest correction of this bull run with 3% correction, and of course the biggest point correction as well. 48 F&O stocks today were down 5%. We spoke about 20 stocks yesterday. 48 stocks down 5% or more. F&O stocks, of course, and some of them real big ones. You had stocks like Kaveri Seeds, Adani Power, Jet Airways. Tata Motors, after its numbers, was down 8%. PFC, Granules, Escorts, Reliance Infra, Raymond. Really, I can go on and on. Strongest of the stocks were correcting today. Escorts, for example, Bajaj Finance, for example. Just that kind of market where everyone is throwing in the towel. So what next? My sense is that 70 to 80% of deleveraging process is now over. And, historically, anecdotally, these things sort themselves out by Friday. And tomorrow, of course, we have Friday. So it's possible that tomorrow, second half, some of these stocks may start to bounce back. But of course, till then, this fall has been a bit of a lesson in terms of not overstaying the welcome in individual mid-caps and small caps because the fall there has been brutal.
Okay, Anuj, thanks for joining in with that. Let's see if, thank God, it's Friday, will hold true for the market. But here's a reason why equities across the globe have seen pressure. The war of words between North Korea and the United States continues to escalate. Today, North Korea announced a detailed plan to launch missiles aimed at waters off the coast of Guam, an island territory of the U.S. that houses a U.S. military command with close to 4,000 personnel. CNBC's Shari Kang brings us the details.
North Korea upping the ante once again, following up on the threat that it made yesterday. North Korea's state-run media, KCNA, this morning saying it will get ready for 4 rockets so that they could land 30 to 40 kilometers away from Guam. And we have a timing for it as well, mid-August, and says the military will be waiting for its leader Kim Jong-un's order to go ahead with it or not. Yes, we have had North Korea making similar threats since 2013 to preemptively strike areas such as Guam, even Hawaii. But what's different this time around is that we have specific details. We actually reached out to Governor of Guam, Mr. Eddie Calvo, and he actually seemed to manage to keep his cool throughout this interview. And he talked about why he thinks North Korea does not want to follow up and follow through with these threats.
There is enough hardware to, again, cause great harm to North Korea. It's important that the United States, Japan and South Korea and its allies, and together with China, which is very critical to this, make it clear to North Korea that the direction they're going is the wrong direction, and it could lead to serious consequences. But we feel very confident here in Guam.
And in the meantime, in South Korea, the military says it's fully ready for anything that comes out of North Korea, for any North Korean provocation.
Well, investors continue to remain jittery over tensions in the Korean peninsula. So let's pull up the European indices for you. Most indices have slipped further in trade. So look at the FTSE, cracked down by about 1%. German DAX losing about 87 points. French CAC recovered a little bit, down by about 0.3%. It was a tepid session in Asia as well. So let's pull up those indices for you. The Japanese Nikkei has ended in the red, fairly flattish with a negative bias, but the Shanghai has fallen quite a bit, down by about 0.4%, and Hang Seng down by a whopping 313 points. But let's get to the big story that kept market on tender hooks today. The other big headline that we have been tracking today, the Securities and Appellate Tribunal has stayed the SEBI order restricting trade in J. Kumar Infra and Prakash Industries. Remember, earlier this week, SEBI had released a list of 331 suspected shell companies and had asked exchanges to restrict trading in those firms to once a month. Two firms, J. Kumar Infra and Prakash Industries, moved the SAT against that order. Yash Jain was tracking this case through the day, and he's here with the details. Yash, firstly, take us through what was argued by SEBI, because SEBI seemed to indicate that SAT doesn't have jurisdiction, but SAT has gone ahead and stayed this order.
Well, yes, the important news coming from the Securities Appellate Tribunal is that the court has stayed SEBI's order of lifting the trading ban on two companies, which is J. Kumar Infra and Prakash Industries. Now the trading ban gets lifted on these two companies for an interim period till the time SEBI concludes its investigation against shell companies. Now, taking you through the arguments which took place in the Securities Appellate Tribunal today, J. Kumar Infra argued that SEBI's order against the company carries larger civil consequences, and an order of this sort could only have been passed by someone who refuses to look at facts. Prakash Industries, another company, also argued that in the hearing which SEBI had given to the companies, the market regulator had sought information which had absolutely nothing to do with the larger issue of Prakash Industries being a shell company. Towards the fag end of the discussion, SEBI also tried to save the case by challenging the maintainability of these two petitions before the Securities Appellate Tribunal. But on that point itself, the petitioner and the defendant seemed divided. All in all, after taking cognizance of the arguments which came in from all these three parties, the Securities Appellate Tribunal lifted the trading ban on Prakash Industries and J. Kumar Infra, looking at the larger shareholder interest.
Okay, Yash, thanks for joining in with that. Let's bring in Sandeep Parekh, the founder of FinSec Law Advisors. Sandeep, we were talking just yesterday about this order. I want to get your comments on what SEBI had argued in court. SEBI had said, and the two lines that stand out is that SEBI's order can't be challenged before a SAT and is hence not maintainable. And the other line that they said is that we suspect shell companies can challenge SEBI's order in writ court and not SAT. What do you make of this argument that SAT is, they are essentially arguing that SAT is really not the right platform to argue this case in?
So this is based out of a ruling of the Supreme Court of 2-3 months back, which essentially said administrative orders of SEBI are not appealable before SAT. Now, this is by no stretch of imagination an administrative order. It's an enforcement action. It's a quasi-judicial order. It has very serious and very specific implications for these companies. So therefore, just because you label all your documents as circular doesn't make them immune to the roving inquiry of SAT. So I find SEBI's, even the argument itself, very bold to say that SAT has no jurisdiction for something which is clearly within their jurisdiction.
So Sandeep, do you believe that SEBI has a case now to go ahead and move the writ court against this order? What are the options before SEBI?
No, so they cannot go to a writ court. At best, they can file an appeal before the Supreme Court. But that's a long-drawn process, and they're unlikely to get any, especially because the order is so absurd that they have called non-shell companies as shell companies and try to virtually give them capital punishment in the economic sense. So I think no court is going to disturb that. And let's see how it goes. My guess is they're going to apply their mind now and kind of pass more recent orders against at least the kosher companies in terms of both operational companies and also those companies which are maybe shell but which are not committing any illegalities.
Sandeep, how many companies? See, there are 331 companies. This is just 2. How many companies are expected to come forth now? Because it's quite surprising that only 2 companies have come forth so far.
See, you must recognize that it's very difficult to file a case within less than 24 hours. So obviously they got lawyers who managed to draft it and file it in the morning and mention it. But I'm sure the other companies must be drafting it right now. And again, I don't know how many will file. At least some of them will file, and that the operating companies will probably get a similar order for the asking of it. Okay. As far as shell companies which have not committed any illegalities, I think that will be probably a second class of aggrieved companies.
Okay, Sandeep, just hang on. There's some breaking news coming in right now. There's the latest from the SEBI versus Sahara case in the Supreme Court. Ambi Valley auction will now go on. So far, the Supreme Court has rejected Sahara's plea to stay auction proceedings for Ambi Valley, and the auction will go as per plan. Sandeep, quickly come in on that.
I have no idea about this case. I really won't be able to comment about it.
Okay, fair enough. Thanks, Sandeep, for joining in with that. The Supreme Court has basically given a nod for publishing of auction, so the auction will go on. Remember, the valuation and a lot of the details had been reported earlier. We'll get our colleague Ashmit Kumar to take us through what was argued in court and what are the implications going ahead. For now, let's take a very short break. On the other side, CNBC-TV18 news break confirmed Softbank invests $2.5 billion in Flipkart. That news and reactions when we return. Welcome back. Here's a big story from the e-commerce space. Softbank may have missed out on getting a piece of Flipkart when the much-anticipated Flipkart-Snapdeal merger fell through last month, but the Japanese conglomerate has finally got there. Softbank's Vision Fund, one of the world's largest tech-focused investment funds, has invested, from what sources tell us, about $2.5 billion in Flipkart. Now, this investment makes Softbank the second largest shareholder in the company. The investment comprises of a mix of primary and secondary capital. So essentially, Softbank has bought part of Tiger Global's stake in Flipkart, and we understand that's about 10%, and has made the remaining investment via a fresh issue. Softbank will now hold roughly around 20% stake in the company, and Tiger Global, meanwhile, will hold about 23% post the investment. So that essentially means that their earlier 33% stake has come down to 23%, thereby implying that 10% stake has been sold directly to Softbank. Now, Flipkart shall have more than $4 billion of cash in the balance sheet after this deal is completed. The deal is, of course, subject to regulatory approvals. That's not all. The investments by Softbank's Vision Fund is the biggest ever private investment in an Indian technology company. That's the big e-commerce story that broke just a short while ago. And we have Anand Lunia, the founding partner at India Quotient, to discuss the implications of this deal. Anand, thanks very much for joining in on the show. What do you make of the investment? $2.5 billion has been invested. In a sense, this is Softbank betting big on a company like Flipkart and the e-commerce story.
Oh, absolutely. I would say that this is a validation of the India opportunity, the e-commerce opportunity within India, and within that validation of what Flipkart has been doing.
And then the $4 billion is the cash on books that Flipkart will have after the deal is completed.
Right.
Amazon, if you remember, had talked about an investment of $5 billion. There's only a $1 billion gap over there in terms of the watches that they have. How close would Flipkart come to be able to meet Amazon in the war that is to follow?
Yeah, I think the Indian e-commerce space has way more funding requirements. I would say this is the beginning. So it looks like Flipkart is on an even footing, and now they can compete equally. But I wouldn't be surprised if over the next 5 years, both Amazon and Softbank put more money. So what is more important about Flipkart is not the $4 billion it has in its own balance sheet, but the fact that it has a backing of somebody with $100 billion of cash, whereas interestingly, Amazon does not have that much of cash.
Yeah, that's the point, Anand, that only worry about 2-3 years ago for Flipkart was the fact that Amazon is coming with a global reportage and a war chest of $5 billion. But now Flipkart, not just Softbank, it has several other global investors as well. Do you think that Flipkart is well positioned to be able to beat Amazon then?
I see, the thing is that, I would like to make this like a movie analogy, right? That, after taking help of Amitabh Bachchan, Flipkart has now Rajnikant, right? But that's not the point. The point is that there probably is room for a lot of growth, right? And a war, and a winner-takes-all market like America, where the overall market is not expanding that much, right, is a different war. Whereas in India, we are seeing tremendous expansion. Right? So if you really look back in the last 2-3 years, Flipkart has held the numbers. Right?
Yeah.
And Amazon basically gained because of the market expansion and also at the cost of Snapdeal.
Yeah, correct.
So I wouldn't say that this is a winner-takes-all market yet. That dynamic of the market probably will emerge maybe when the market matures. Today, the market is growing so fast that we're not going to see winner-takes-all behavior as of now, especially because both the companies have equal access to money now.
Okay, Anand, we are very tight on time. One line answer, if you can give me. Consolidation has started, of course. How many players do you think will remain at the end of 2 years?
We definitely have 3.
Okay. Fair enough. Thanks, Anand, for joining in. With that, we'll take this discussion forward. But for now, let's slip into a very quick break. Up next, the government's midterm review reiterates LPG cylinder subsidy to be eliminated by March 2018. More highlights up next. Welcome back. The government's midterm review reiterates LPG cylinder subsidy to be eliminated by March 2018. Overall subsidy bill will fall to 1.3% by 2020. Adds that the GST rollout is unlikely to cause tax shocks on collection. Ritu Panabhoyan is here with a comprehensive detail of that list. Ritu, take us to the fine print of this document.
Let's start by looking at what this report says about the revenue collection front and issues. Remember that this is the first year of GST implementation, and the report says that there will be a disruption in overall revenue collections due to GST. But this shock regarding revenue collection will be limited to this fiscal itself, and as a result, the tax to GDP ratio in FY18 will be at the same level as that of FY17. But for FY19 and FY20, the report expects an increase of at least 30 basis points for both these financial years as the tax base expands. Also, the report talks about how the government needs to relook into the target of totally eliminating effective revenue deficit. Now let's quickly take a look at what the report says about different expenditure heads. On the subsidy front, the report expects a decrease in subsidies to fall to the level of around 1.3% of GDP by FY20 as compared to 1.7%. And it talks about how the government has actually targeted to reduce or eliminate LPG subsidies totally by March 2018. It also talks about how the efforts to rationalize kerosene subsidies, that has also started. As far as the big capex related headings of the government is concerned, this report talks about how defense tops the list and expects defense expenditure capex to touch 1 lakh crore by FY20, followed by railways. Railways also will see a handsome increase in capex. In road transport, the capex by FY20 is expected to be at around 70,000 crores. Also, another head for capex for the government going forward will be Department of Financial Services, but the government has not specified on what specific heading of Department of Financial Services. With that, it's back to you.
Okay, Rituparna, thanks for joining in with those details. Let's get to an exclusive in the telecom space. Telecom major Bharti Airtel's mega plans of selling its tower business to KKR and Canadian Pension Plan Investment has hit a roadblock, and this may result in the listing of the combined tower business, Indus Towers, as the largest tower company in India. Nisha Podar has been tracking the story and she's here with the details. Nisha, what are you picking up?
So sources with direct knowledge of the development, and several of them that CNBC-TV18 spoke to, have confirmed to us that currently the deal is going slow when it comes to Bharti Airtel's plans of selling Bharti Infratel on the whole to KKR and CPPIB. Valuation is one concern. The stock has run up for Infratel, but on the other hand, the bigger concern is coming in because of Indus Tower. Remember, in Indus Tower, Bharti Infratel has 42% stake. Vodafone and Idea are also the other two players. Now remember, Idea, Vodafone, which are in merger talks and process is almost complete at this point. The final leg of merger is happening. At this point, they need cash by monetizing their tower assets. So at this point, they need that cash. And for that to happen, they need to sell their stake in Indus Tower at a higher valuation. That's where the problem really lies, because there is a disconnect when it comes to the valuation. On the other hand, capital gains tax is another key factor for that. So all put together, that deal not going through could be a dampener for Bharti Group. On the other hand, an Indus Tower IPO could create one of the largest telecom tower companies in the country.
Okay, Nisha, thanks for joining in with that. Here's another big story today. The Comptroller and Auditor General pulled up rural electrification on corporation and Power Finance Corporation today. The auditor observed that the two firms failed to comply with RBI's norms on loans given to private power companies. Ritu Singh joins in now with the details. Ritu, you've gone through the detailed report. What were the findings of the CAG?
Well, the key finding is that, in giving out loans to independent power producers, a lot of norms are flouted, specifically in credit appraisals, both internal and those of the Reserve Bank of India. The background in which this audit was conducted is that, over 47,000 crores of loans were given out by these two banks to NBFCs, to independent power producers in the last 3 years, and 21% of those have turned bad, where repayments have not come in. What the report really finds, or the findings of the Comptroller Auditor General audit, is that REC and PFC in 6 cases, of the sample size that they had taken, had estimated higher tariffs at the time of appraisal of the loan, which resulted into the viability of the project then being into question later. The assessment of the experience of promoters was not properly done. There were several projects that were restructured multiple times, which resulted in higher interest outgoes, as well as, non-performing assets being created out of them. The financial capacity of promoters is also something that was not appropriately assessed by these companies. So several flaws on those fronts, because of which this audit report has now suggested measures to enhance and improve the credit appraisal skills of both REC and PFC.
Okay, Ritu, thanks for joining in with those details. We're completely out of time on this edition of After the Bell. Many thanks for watching. Stay tuned to CNBC TV 18 Markets Today. The fear factor is up next.